Seth, we have a great clientele. They are wonderful people and they love to give. They love to make donations, and you help us out by determining the best way to make their donations work for them. Can we talk a little bit about that?
Absolutely. So I'll go over 4 different areas today. The first and foremost one that I like to talk about is QCDs, which stands for Qualified Charitable Distributions. So if you're over 70 and a half, you're able to give money to charity directly from your IRA. We can mail it straight to the charity, or we can mail it to your home, and then you can give money to the charity. This is important because a lot of our retirees file a standard deduction and they're not able to take advantage of the gifting. With a QCD, they would be able to take advantage on their tax return of their gifting, and it normally helps bring down their income.
And if they can do it at 70 and a half, when they turn 73, which is required minimum distribution age, we're helping to help reduce that required minimum distribution.
Oh, absolutely. 73 is when the RMDs start, but again, 70 and a half is the QCD age, and a lot of people forget that. You know, I always tell clients, once you turn 70 and a half, you need to stop giving money to charity. You need us to give it on your behalf.
What would number 2 be?
Number 2 would be gifting appreciated stock. So let's say that you put $1,000 in Apple years ago and it's now worth $10,000. If you tried to sell that Apple stock, you would have to pay capital gains on your profits.
A lot of capital gains, yes.
If you gave that money away to charity, the nonprofit doesn't pay any taxes. So whether you give 1,000 of the stock or 10,000 of the stock, they get it, they sell it immediately, and there's no taxes paid. So the charity still gets the same amount of money. They don't pay any taxes, but you avoid the taxes that you would have had to pay. Now here's one really important part of the logic that people always forget. They only think about giving away stock that they want to sell. They don't think about giving away stock that they want to own. And I want to try to explain this a little bit because it's a little complicated. So let's just use that same Apple stock scenario. It's worth $10,000. You give away $10,000. People say, I don't want to give away my Apple stock. I want to keep my Apple stock. So you can give $10,000 to the charity and just take the $10,000 that you were going to give to the charity and buy the Apple stock right back. Now your cost basis going forwards is $10,000, not $1,000. So if you decide to sell it tomorrow or a year from now or 10 years from now, you've now avoided the taxes on that $9,000 of profit. So the important part with number 2 is people only ever want to give away the stock they want to sell. We just want to give away stock.
And just to clarify, for qualified charitable donations, that's from a traditional IRA. From gifting appreciated stock, that's from a general brokerage account?
Yeah, just from your general account. Absolutely.
And that can be any age?
Anybody,
any age.
And it can also be anything that's appreciated. It doesn't have to be stock. It could be land or anything.
Okay. What about number 3?
Number 3 is also a little technical, and that is the concept of bunching. So again, a lot of people file a standard deduction. They give money away to charity and they're not able to get a benefit from it. So what bunching means is that you give multiple years into 1 year. And so how a lot of our clients would do it is they would just regularly give whatever they're going to give throughout this year. And then at the very end of this year, they'll give everything that they were going to give next year. The reason that's important is if you give away twice as much in 1 year, you might go over the standard deduction and then be able to itemize and then actually get some benefit from some of that donation. And if every other year you give twice as much, it has saved some of our clients many thousands of dollars a year on average on their tax return.
And I bet they're really happy to have you walk them through that process because it is detailed.
Yes, it's kind of hard to explain on a video, but much easier on a whiteboard, and we work with people's CPAs to explain the concept and give it away.
Okay, and then you said there was a 4th one.
So number 4 is a donor advised fund. I'm just going to give you the 30,000 foot view because I could talk about this forever, and we're going to have another video just on donor advised funds. But basically you're making your own personal endowment fund. You could give away, say, $100,000, and then you could give away any or all of it whenever you wanted for as long as you wanted to charity. And the cool part is you could create a legacy of giving. You could instill that giving mentality in future generations.
All right, so there's a lot of different ways to give, and I'm really happy that they have a team to help them with that process.
Absolutely.